You're about to learn why one semiconductor company is capturing investor attention in ways that most traditional AI plays simply cannot. The answer requires you to think beyond the headlines. Broadcom isn't just a chip manufacturer. It's positioned at the intersection of two of the most powerful investment trends reshaping technology right now. Let's start with what everyone knows. The artificial intelligence infrastructure boom is accelerating. Every major technology company is in a race to build data centers capable of training and running large language models. Google is building them. Microsoft is building them. Amazon is building them. This isn't theoretical. This is billions of dollars in capital expenditure happening right now, and the race shows no signs of slowing. If anything, it's accelerating. This infrastructure build-out requires semiconductors. Lots of them. Think about what a modern AI data center actually needs. It's not just processors packed into racks. You need sophisticated networking fabric to connect thousands of chips together in real time. You need switching equipment and interconnect solutions that can move massive amounts of data between processors at incredible speeds. Memory systems and specialized infrastructure just for orchestrating all these components. Broadcom manufactures exactly these kinds of networking and infrastructure semiconductors at the heart of these data center deployments. When hyperscalers architect their AI infrastructure, Broadcom chips are specified into those designs. This puts Broadcom in an enviable position. They benefit directly from every major company's AI spending surge. As companies accelerate their build-out, Broadcom's revenue grows with it. This is the first narrative, and it's compelling on its own. Broadcom is capturing a share of one of the largest capital expenditure cycles in technology history. But here's where most investors stop. They see a semiconductor company riding an AI boom and think they've found the complete story. They miss what makes Broadcom structurally different. Most semiconductor companies are purely cyclical. They design chips, sell them to data centers, and when demand softens, they suffer. It's boom and bust. It creates volatility. For shareholders, it's exhausting. Broadcom is intentionally breaking this cycle. They're not content to be a pure hardware play. They're moving aggressively into enterprise security software. Think about what's happening in corporate environments right now. AI systems are proliferating everywhere. Companies are deploying machine learning applications across their operations. These systems process sensitive data. Customers trust companies with information, financial data, personal information, proprietary business data. The attack surface is expanding rapidly. Hackers are developing new techniques specifically designed to exploit AI systems. They're targeting vulnerabilities in model training, attempting to poison datasets, and trying to steal trained models worth millions in development cost. The need for security has never been greater. Companies must protect their AI infrastructure from emerging threats. They don't have a choice. They're spending heavily to do it. Security isn't optional anymore. It's mandatory. Broadcom is positioning itself to capture that security spending. This is the second narrative, and it's equally important. As AI systems become embedded in enterprise operations, security spending becomes mandatory. It's not optional, it's not a nice-to-have, it's urgent and necessary. And it grows independent of whether the hardware boom continues. Now here's why both narratives matter together. By moving into enterprise security software, Broadcom is creating vertical integration. They're not just making infrastructure chips. They're moving up the technology stack to protect those systems. But here's the strategic breakthrough: they're building a recurring revenue model. Software subscriptions generate revenue quarter after quarter, year after year. They're sticky, they're predictable, they're not tied to hardware refresh cycles or capital spending surges. Software revenue creates dependable, forecastable cash flows. Think about what this means for earnings quality. Traditional chip revenue is lumpy. One quarter could be strong, the next weak, depending on data center deployment schedules. But software subscriptions smooth out that volatility. They create a revenue floor. That's transformational for a semiconductor company. Think about the business model implications. Most chip companies are exposed to a single trend, whether enterprises will invest in AI infrastructure. If that spending slows, their growth slows. Their stock gets hit. Their valuation compresses. That's the semiconductor cycle. Broadcom is building a different equation. They have two separate engines running simultaneously. Engine 1 is traditional semiconductors riding the AI infrastructure wave. Engine 2 is security software riding enterprise security spending. Those aren't the same cycle. They're not perfectly correlated. If chip demand softens, security spending might stay strong. If infrastructure growth plateaus, enterprises might accelerate security deployment. One company. Two independent tailwinds. That creates structural resilience that most pure-play semiconductor companies simply don't have. The market is beginning to price in this dual narrative. Look at Broadcom's recent stock performance. It's been volatile, which tells you something important. Volatility suggests the market is still digesting the story. The dual-engine thesis hasn't been fully baked into the valuation yet. That creates opportunity for investors who understand the narrative early. Here's the practical takeaway. If you're looking for exposure to the AI infrastructure boom, Broadcom gives you that through their semiconductor business. You're betting that companies will continue their massive AI spending. That's a strong bet. But here's what separates Broadcom from other semiconductor companies: you're simultaneously getting exposure to enterprise security spending. That's a separate, independent thesis. You're not choosing between infrastructure or security. You're getting both. You're getting two investment bets in a single holding. That's powerful positioning. The real question investors should ask is which business matters more to Broadcom's future. Is it the chip business or the software business? The honest answer is probably both matter, and increasingly so. As Broadcom gradually shifts revenue to software, the company becomes less dependent on cyclical semiconductor markets. Earnings become more predictable. Stock volatility decreases. That's the kind of business transition that can re-rate a stock higher over time. That's what separates a pure cyclical semiconductor company from a more balanced, resilient business. This is where sophisticated investors see what the crowd misses. Most people hear the name Broadcom and think semiconductor company. That's technically true, but it's incomplete. Broadcom is becoming a company that serves both the infrastructure layer and the protection layer of enterprise AI. Those are two distinct markets. Understanding that distinction could be the difference between a good investment decision and a great one. That's what matters about Broadcom today.